Hello and welcome back to London for another edition of London Direct. In recent weeks, we've seen concerns over Chinese growth and also the effects of tapering hit commodity currencies. So where will they go from here? Well, I've been speaking to Craig Erlam from Alpari. We've been told for a long time now that risk on, risk off is dead in the FX market. So when we're looking at commodity currencies, what's driving investor sentiment there? Is it a case that investors need to monitor the talk of tapering and also the Chinese growth story?
I think China's playing a much bigger part actually in commodities at the moment. Obviously, China's one of the especially since 2008, 2010, has been one of the really responsible for a lot of the demand for commodities ever since there was that huge investment splurge from the ruling party back then to counter the recession in other parts of the world, the lack of export demand. So there was big infrastructure projects which led to higher demand for these commodities. So I think they've been so largely responsible for this that the fact that we are seeing this slowdown towards 7.5% growth in the second quarter, potentially falling as low as 7 if not lower this year. I think that is now going to be largely responsible for these commodity prices, probably still a lot further way to go, a lot further lower to go yet.
What do you make of the China growth story? I thought there was a story this week which really didn't make as many waves as I expected, where the Premier said that he was going to make sure that growth stayed above 7%. Surely that's decent growth for the world economy, right?
It is, but when you look at the historicals, like the growth of the past 5 years in China, where you're looking at 10+% growth, 7% would have almost been seen as a soft landing back then. Now it's become a little bit more acceptable. Now you're looking at a soft landing maybe being 5%, a hard landing being 3%. But yeah, it is obviously good news, especially when there's a lot of stories. I mean, I think there was a Barclays report where they suggested that growth could fall as low as 5% this year or next, depending on just how false this information is in the exports data, and then even as low as 3% in the next few years. So in that term, it is good because it shows that they're willing to support the economy. They are focused on these reforms, this restructuring to move towards away from this export investment dependent economy and more towards more domestic spending and more domestically led. So it is positive that they are, while they are focusing on that restructuring, that they are willing to look at other ways and means to keep this growth at these higher levels. And it's important, like you say, not just for China, but it is important for the global economy, given, like say, how much they do import commodities and how much they export to the rest of the world. So
yeah, let's focus on Australia. Obviously, one of the most attractive aspects of the Australian dollar has been the carry trade, its higher interest rates. But are you expecting the RBA to start trimming their rates now?
Well, they've already trimmed them now to all-time lows. I think they're at 2.75% at the moment. I think we could have a few months now where we do see them lay off a bit. I think inflation's on the rise slightly there. And also, while we wait and see how this situation pans out in China, are the ruling party going to step in and try and come up with some kind of fiscal stimulus plan in order to encourage more infrastructure building and more investment in companies and in roads, etc.? Or are they going to sit back and let this play out, let the growth fall? It does look like, say, based on the comments from the last couple of days, that they're going to invest if need be, if it starts to fall below that 7% level. But I think now the Reserve Bank of Australia are probably going to wait and see how China approaches it, and if inflation starts to come down again and if the economy really is under threat. I think we'll probably see 1 or 2 more rate cuts from Australia this year in order to counter the more domestic issues they have at home. So
what does this mean for the Australian dollar? That would surely mean that there's further downside to Aussie dollar if there's going to be more cuts.
Yeah, absolutely. Maybe not straight away. We have seen such a significant fall over the past few months. I think what we're now just seeing is pairing some of these losses that we've seen recently. I still think there's probably further up to go. I think we're at this key real 93 level. There's quite a few levels of resistance above here. You've got 93, around 93.50, and just below 94 as well. I think you've got the 50-day simple moving average. So on a technical standpoint, this is quite a significant level, which is why we're seeing so much resistance. I think we've had 3 attempts to break above here now, and the sellers have come back in and continue to push the price lower. I think it could go potentially as high as 96 before then pulling back. On the downside, if we do see it continue to push lower, 90 is obviously the key target. That's the previous lows. Also quite a major psychological level. But I think we could see it target 88 towards 86 maybe towards the end of this year, maybe towards the middle next.
Let's move on to a slightly more specialised currency, the Kiwi dollar. Is that simply going to track what the Australian dollar is doing?
I imagine so. I mean, a lot of what you do see in the Kiwi dollar is really is the same as essentially what you see in the Aussie dollar. They're both export-led. They're both commodity-based currencies. They both export a lot to China as well. So I think what we are going to see in the Kiwi is going to be extremely similar to pretty much exactly the same as what we're going to see in the Aussie dollar. We've still seen that major sell-off over the last few months, and we are seeing it pair in some of those losses. But I think the movement we are going to see now in the coming 3-6 months is going to be pretty similar.
Yeah, let's just finish off with looking at Canada. Canada's slightly different to Australia and New Zealand, that it produces a lot of oil, which has got a big market, and also it has the US to the south. Are you expecting the Canadian dollar to weaken over the coming months?
I think we potentially actually could. I mean, for now, it's being supported by the fact that we have got those high oil prices. We're seeing Brent crude and WTI trading at 106 and 108, I think it was. But now, the thing with oil prices is they are very volatile, and I think a lot of people are now seeing these at highs. I think people saw them maybe at 110. Really pushing as high as 115 at the top before. Firstly, you start to see it have a damaging effect on consumer, on the consumer, and therefore on demand. But then you've also got the other aspect of we are seeing slowing down in with the US economy is not necessarily performing as well as we expected to at the start of the year. We've got China who are performing far worse than we were expecting at the start of this year. We've got to remember as well, China's been so largely responsible for so much growing demand for oil. They've been largely responsible for pushing not only just normal commodity price up, but oil as well. So I think once we start to see that demand fall back, I think we should see the price fall low, and that should obviously have an impact on the Canadian currency as well.
Yeah, so just very briefly to finish off, generally speaking with commodity currencies, is this a good time to buy them? As
a short-term buy, potentially, just because we have seen, especially like I said with the Aussie and the New Zealand, we have seen it pull back so significantly recently. In the longer term, I still think they're going lower. I'd be, rather than trying to look for a time to buy it and see where I'm going to get out, I think I'd be more personally looking for an entry level, trying to find a place where I can sell the currency and then ride it back lower towards, like I say with the Aussie, maybe like those 88 levels.
Well, Craig Erlam from Alpari speaking to me there. That's all for this edition of London Direct. So for now, goodbye.